Gonna take just one more second here. Okay, here we go. So how to use the 20 and the 200 period moving averages in your trading. Okay. First off, just want to say that most people that don't use the moving averages, or actually kind of bash the use of moving averages, truly don't know how to use them. That's the truth. I'm going to show you, I'm going to prove it to you in this presentation. Also, just so we're clear, anything we talk about is for educational purposes only. It's not to be construed as a recommendation to buy or sell any securities. Okay, so first, please understand that MA's moving averages are directional guides that basically speed up technical analysis. It just makes it much faster, quicker to analyze charts. The moving average is obviously pointing up, then you know this is a bullish stock, right? If it's pointing down, then you know it's in a downtrend. So it just speeds up technical analysis and reading charts. Some basic guidelines. First, the color of the moving averages should be consistent across multiple time frames. Should be, if you use the 20, the 200, whatever other moving averages you use, they should all have the same color. I mean, they should each have the same color across the multiple time frames. The type of moving averages really does not matter, but it should be the same on all time frames. Exponential, simple, whatever you want. I use simple because that's what most traders use, and I want to see what they're looking at. Because trading is, we're not trading in a vacuum, we're trading in a marketplace. So I want to see what other people are looking at. The moving averages are superior tools in uptrends and downtrends. In sideways trends, their importance is greatly minimized, almost of no use, but I'm going to show you how to use them also in sideways trends. So when the moving average is in an uptrend, is pointing up, the stock price will actually respect it and most of the time trade off of it, bounce off of it, like we see here on Facebook. When Facebook finally gapped down, then the moving average kind of kept the stock below it. It just halted it from going up. And again, easy to see when you have a moving average, easy to be able to tell that the stock is in an uptrend, and the same when the stock was in a downtrend. Blue is always the 20 period moving average. The red is the 200. When the stock is going sideways and the moving average is crisscrossing price or going through price, it's of no use. You see, it's of no use. The stock is not going to bounce off of it or drop off of it. It's not going to react to it. It's ignored. So when the stock when a stock is in a sideways trend, moving averages, or especially the 20 period moving average, is of no use. Exception: when stocks are about to transition up or down, the moving average will start to hug price and curve up. That's your indication that the stock is about to transition into a stage 2 uptrend, and vice versa when it's about to transition into a stage 4 downtrend. So even when the stock is going sideways, I still would keep the moving average on the chart because it will give you that heads up when it's about to break out. Sideways trends are always temporary. They always lead to, you always get a breakout or a breakdown eventually. And when the stock is about ready to go higher, the moving average will start to curl, to point up, and the price will start to put in higher lows right off the moving average. Now, if you don't have the moving average on the chart, you might not be able to spot the higher low here or the previous chart. You might not be able to realize that there is a higher low here and the stock is about to break out. Does that make sense? So again here, notice the higher low, notice how the moving average started to point up. That's your sure sign that it's going higher. It's transitioning higher. Okay? Same here. This is what I call the halt, the HALT. It halts the stock from continuing to break the moving average. Now it's respecting it, and so it's your sign that it's going to transition higher. Question, does this apply to, what time frame does this apply to? It applies to every time frame. Every time frame is the same, except that obviously the daily chart has gaps. That's the only exception, but all time frames are the same. And moving averages apply to all time frames the same way. Again, going through price, while the moving average is going through price, you don't want to really be touching that stock. It's in a sideways trend stage 1. When it starts to point up, then that's your indication that it's going higher. It might be higher for just a day or two. It might be higher forever. I mean, for a long, long time. This is CLVS actually. Okay, had the breakout. It went to $100. Okay, it went to $100. Notice the transition there. So, okay, so I trust that's clear enough so far. Now, the direction of the 20 MA, a rising 20 period moving average represents positive market action or strength. It represents a stock that's being bought, right? A falling 20 MA represents negative market action or weakness. During a strong uptrend, retracements tend to halt near their rising moving average. During a strong downtrend, rallies tend to halt near the declining 20 moving average. Following penetrations of the 20 MA, pullbacks to the now broken MA become very likely. So when the stock is trading off in an uptrend and is bouncing off of the 20, perfect. It bounces every time. But once it finally breaks it, right? You get the next retracement. In this case, we really didn't get much of a retracement, but the next retracement will also break it. Next retracement broke it every time. So again, when you have a retracement that breaks the 20, so in this case, didn't break the 20, didn't break the 20. When you have a retracement that breaks the 20, the next one will also break it. Next one will also break it. Okay? Because now it's no longer relevant. The stock is basically going sideways. All right, once it broke it, as I said, and that's your indication that the trend is almost over, right? The slope of the 20 MA. The slope or the angle of the 20 MA is indicative of the strength or weakness of the underlying stock. 45-degree is ideal. Okay? Steeper than 45-degree is not sustainable. It means the stock is going a little climactic, not a sustainable trend. It's really getting bought too fast, and it will run out of fuel, probably not in the too distant future. And if it's shallower than 45-degree, it means it's too weak or lacks momentum. So 45-degree is definitely ideal. That's 45-degree. Okay, that's 45-degree. Beautiful. That's a little too much. That's like 75-degree. 75-degree. And so that is not sustainable. When it starts to accelerate like this, that's not sustainable. That's 45-degree. See it? From the upper left corner to the bottom right corner. And that's just a beauty. Entry is almost always at or near the declining 20. So, and where's the entry? Just as soon as the stock takes out the prior bar's low. So again, where's the entry? As soon as it takes out the prior bar's low. As soon as it takes out the prior bar's low. It's right here, right here, right here. Does that make sense? As long as you have a 45-degree 20 MA, it should work. Not, not 100% of the time, but the vast majority of the time. Again, 45-degree from maybe here to there and up here is now more than 45-degree. Stock tops out shortly afterwards, right? Now, when playing the trend, just understand that odds are much higher in the direction of the 20 MA. So if you have an uptrend, odds are the odds are in your favor if you play in the direction of the moving average. If you play against it, you can still make money sometimes, here, you know, if you shorted, you made money here. But look at this. Look at the move before you get this little drop. Look at this move. So odds are in your favor if you play in the direction of the trend rather than against it. Of course, there are exceptions, and that's when the stock goes climactic, when it goes way up and goes vertical. Then you can, that's the only time that I go against the trend. That's actually the only time that I look to go against the trend. So odds are in your favor if you play in the direction of the 20 MA rather than against it. The 20 MA must be going from the bottom left corner of the chart to the upper right corner of the chart when playing long. When you're looking to time your entry, always make sure it's at or near that the entry that price is at or near the 20 MA, right? That price, so this is kind of, I need to reword it, that price is basically at, so price is at or near the 20 MA, not far away from it, always. The 20 MA must be below price, not above it when you're playing long. Even if it's a rising 20, you want it to be below price or right at it, but not above price. The 20 MA is not crisscrossing price, it's not going through it. And the 200 MA, you want it to be below price also, not above it. We're going to talk about the 200 MA in a little bit, so you'll understand why that's important. And remember that the correct entry is almost always at or near the rising 20 MA when playing long or the declining 20 MA when playing short. However, we don't enter simply because price is at the 20 MA. We must have a tradable pattern at or near the 20 MA. Okay? Some trends are so beautiful that you can almost just fall in. Just get in anywhere near the 20 MA. It almost doesn't matter if the stock is hugging the 20 MA, right? You can almost just fall in, is how I like to say it. Now, additional uses for the 20 MA. The 20 MA can be used to expedite the scanning process, right? If you're looking for bullish stocks, obviously you want a rising 20 MA. If it's not rising, you can just immediately move on. Or if it's a flat 20, then you know it lacks the momentum, it's trendless at the moment, so move on also. So to expedite the scanning process, determine the stock's extension. For example, when you have a stock that, let's say, is trading up here, and you have a moving average that's just below it, like so. That stock is not extended, right? The moving average is right below it, but when it starts to speed up, now it's extended. See how far away from the 20 MA it is? We can also look at real life examples, obviously, here. You know, this chart or any of the charts that I showed you, not extended, right? Not extended, but look at it up here. Look how far away from the moving average it is. So you can tell whether a stock is extended or not by how far it's getting, how far it's starting to trade at compared to the moving average, where the moving average is at. So you can determine the stock's extension. You can also locate support and resistance because in an uptrend, support is almost always found at or near the moving average. At or near the moving average. There are 3 locations where I look to play long when we're in an uptrend, and they are the following. One is what's known as minor support. Minor support is at the prior pivot high. What was resistance becomes support on a pullback, right? So that would be support. The same here, of course. At this prior pivot high, that's support. I'm going to redraw this because my annotation tool just froze. So I'm going to reopen it. Okay, so again, in an uptrend, support, let's do it over here. Support is found at at what used to be minor resistance. That's where support is. And that's also the 40 to 60% retracement percentage. And also where the 20 MA will be at. So this is the beautiful thing about the moving average is you don't even have to look for support. If the stock is in an uptrend and is pulling back to the 20 MA, it will be at support. And it will be most likely at the 40 to 60% retracement percentage zone, which is the area that we recommend buying or looking for an entry in that area. So it's useful for locating support and resistance. You can also use it to determine if there's a price divergence, meaning if, remember that extension issue that we talked about, but sometimes it's a little bit different. Moving average is going at this angle, let's say, and then, or let's start over. Moving average is going at this angle, at this rate, let's say 45 degree or 40 miles an hour, and the stock starts to, initially is tracking the moving average like so, but then it shoots up, right? And the moving average continues to go at the same rate. It's unlikely, but when that happens, that stock is poised to fall right back down. You want the moving average to follow price. Whatever price does, the moving average needs to do the same to some degree. If there's price divergence, then you'd expect a pullback right back to the 20. You can also anticipate reversals, obviously, since moving averages price respects the 20 MA greatly when it's in an uptrend. So you can actually anticipate reversal areas before you even get the reversal there. You can also anticipate a rise in volatility. Typically, to be able to anticipate a rise in volatility, you want to have two moving averages, a fast moving average and a slower moving average. And then when you get the moving average crossover, that's when you can anticipate a rise in volatility. But you can also anticipate it when the stock finally halts the price from actually continuing the downtrend, like I showed you earlier. For example, here, right? You can anticipate it when it finally anticipate the rise in volatility when the moving average finally again halts the price from continuing lower, like so, right? As long as moving average is going through price, it is indicative of lack of momentum or lack of momentum and a sideways trend. And now I am trying. See the CLVS? Look, in one day, right? In one day, $7,600. Would I have made that if I didn't have the moving average? I'm not sure. I'm not sure I would have been able to spot it setting up here without this moving average being on the chart. When I see the moving average starting to halt price from continuing to go through it like it was here, then I'm gonna get ready to, to strike, to get in that stock. So, okay, going back to that slide, anticipate a rise in volatility, calculate the risk to reward. When the moving average is your target, then you can actually calculate the reward to risk. For example, every single climactic that I do, the moving average, the 20 period moving average is my target. So if I get in here, my stop is here, and let's say the moving average is my target, the target is right here, then I know the stock has about, let's say, 2 to 1 reward to risk. So you can actually use it to calculate reward to risk. And finally, you can use it to determine relative strength to relative weakness. For example, if you put two stocks next to each other on the same time frame, one stock trading above the moving average, or the market, let's say, is trading above the 20 MA on the 5-minute chart, and your stock, the stock that you're considering playing long, is not trading above the moving average on the 5-minute chart, then you know your stock actually has relative weakness to the market. Does that make sense? So just based on where price is in relationship to the 20 MA and compare that to the market, that should tell you whether your stock has relative strength or relative weakness. If it has relative weakness, obviously you don't want to play it. Okay? Questions. Do you require this pattern on the daily and the 2-minute time frame? I'm sorry, which pattern was that? Were you talking about the sell setup? Or were you talking about the pullbacks? What I'm saying here applies to every single time frame. As I said earlier, it applies to every single, yeah, the pullback to the moving average applies to every single time frame. So if I'm day trading and I'm using the smaller time frames, it just has to be at the 20 MA on the smaller time frames. It doesn't have to be on the 20 MA on the daily and the smaller time frames. But guess what? If the stock is at or near the moving average, the 20 period moving average on both the daily and the intraday time frame that I'm looking to trade, so much the better. So much the better. It means this stock is ready to go on the larger time frame, the daily chart in this case, and whatever other intraday time frame that you're using, the 2-minute, the 5-minute, the 15. So that's even better. That's even better. Does the moving average apply to the crypto market? 100%. Yes. The moving average applies to every moving instrument, okay, that's traded in an open market. And the 20 period moving average is the most used and watched moving average in existence, especially when we have a trend going on. If you put a 20 period moving average on a chart and just see how price trades off of it, you'd be shocked in the cryptocurrency market as well as in the equities market. In any market that's traded that's traded in the public by the public. Okay. All right. Now the 200 period move. Any other questions about the 20 period moving average? Let me know. So again, the ones that really bash the use of the moving averages as another indicator don't know how to use them. That's the thing. They don't know how to use them. But I also want to say that the moving average in and of itself, by itself, is useless. You have to also know how to read price action. And the moving average becomes kind of just a helpful tool, a very, very helpful tool. Question, is the MA nothing but simple moving average indicator? Again, I use simple, but there's exponential, there's weighted, what else is there? The most popular ones are the simple moving average and exponential. But I use simple. You can use whatever you like. Okay. The 200 period moving average is a long-term moving average, unlike the 20 is a long-term moving average. And because it's not used for trend-based trades, flatness is king. Okay, you want it to be as flat as possible in order for it to be effective. And I'm going to explain that. I'm going to explain what I mean in just a minute. While the 20 MA is most powerful when it's trending, the 200 is strongest when it's flat. Think of the 20 MA as a floor to stocks above it, meaning when a stock falls to the 200 MA, it's going to act as support, and as a ceiling to stocks below it. Stocks that are trading below it, if they were to rally up to the 200, it's going to act as a resistance. A level floor is always preferable to a slanted one. It is true that a level floor, a flat 200, is much more powerful than a slanted 200, than a trending 200. Think of the 200 MA as a line in the sand. In general, stocks trading above the 200 MA are basically being accumulated. Stocks below the 200 MA are going through their distribution phase. In general, stocks above the 200, they would not be above their 200 period moving average if they weren't being accumulated, because the 200 period moving average is the average price of the last 200 bars. So if the stock is above the average, it means it's being accumulated. It's being bought. It's a bullish stock in general. I'm not saying it's a bullish stock at this moment or this day or this minute. I'm just saying in general, that's a bullish stock. If it's under the 200, that's a bear stock because it's currently trading below the average of the last 200 bars. As such, do not look to short, in general, do not look to short stocks above their moving averages on that time frame. So if you're looking at a 5-minute sell setup or a breakdown and then the stock is above the 200 MA on the 5-minute chart, you probably don't want to do it. That doesn't mean the stock, if it's a swing trade based on the daily chart and the stock is above the 20 MA on the 200 MA on the 5-minute, that doesn't mean you can't do it. I'm talking about one time frame at a time here. If you see a setup on a given time frame and the stock is above above the 200 period moving average, you don't want to short that. Similarly, do not buy stocks that are currently trading below their 200 period moving average. Okay, it's really important, by the way, really important. As I said, the 200 MA can be viewed as support and resistance. As support when price is declining towards it, as resistance when price is rallying up towards it. Okay? This is also especially true if the stock is extended and falls hard to the 200 MA or rallies really hard to it. It is especially true if the stock was extended and puts in a 3 or more consecutive green bars or red bars to the 200 MA. Let me show you some examples. You see what I mean? Was extended, actually gapped up, fell really hard into the 200 on the 5 and the 15. Beautiful when you have multiple time frame alignment. That's support. That is support. Look at the move up. That's support. Look at the move up, right? 5-minute, 15-minute as resistance in this case. Up, and then into the 200 MA. Same here. That's a short. That's a short. And look at price now, 35.52. So big drop right off the 200 period moving average. Okay. So here it is, down a lot, and then 3 bars in a row to the flat-ish 200 period moving average. Was there price support? If you look to the left here, was there any support here? No, there's nothing. So why did it bounce over here? Because there's the 200 period moving average. That's what it is. Basically, I think I talk about it in here. Let me see. Do I talk about it? Basically, the moving averages are subjective Western style tools designed to locate support and resistance. They're not objective price support, but enough people use them that they become support. So again, if enough people buy right off the 20, the 200 in this case, if enough people buy right off the 200, even if there's no support to the left, the stock is gonna bounce off of it. So it becomes support. So the 200 period moving average becomes support, even though it's just a line on the chart that people react to. So keep that in mind. Okay. Now here's how we talked about how to use it as support resistance, as a line in the sand. Okay, as support and resistance, as a line in the sand, stocks above it bullish, stocks below it bearish. We said flatness is king, right? Okay, good. So here is also other ways to use it. You can use it as a gap strategy. Buy at the open stocks gapping just above a flat 200 MA on the daily chart, gapping up just above and then gapping down just below. So buy at the open stocks gapping up just above a flat 200 MA on the daily chart regardless of the quality of the gap. Would you believe that? I'm saying it. So I believe it. If a stock gaps up just above the 200, you can almost disregard the quality of the gap. Whether it's good, bad, really powerful, really mediocre gap, you can just buy it right at the open. Short at the open, look to short at the open, stocks gapping down just under a flat 200, flat 200 MA on the daily chart, regardless of the quality of the gap. However, you want to wait for a pullback to the 200 MA before buying a stock that is gapping well above a flat 200 MA. So if it gaps well above on the daily chart, you want to wait for a pullback. Or if it's gapping well below the 200 MA, then you want to wait for a counter rally before shorting it. Let me show you some examples. See this? Daily chart, right? This daily chart, just off the 200, right into resistance. Doesn't matter. Bam! Big move up. Just off the 200. In this case, was not right at the 200, slightly above it, and that's why it pulled back a little bit before popping hard, rallying almost $2. See this? Same thing. I can show you 100 examples probably. See this? Same thing. Above it. In this case, not quite at it. So that's why you see the bottoming tail, meaning it came in a little bit and then rallied. So, and regardless of the quality of the gap, I mean, this wasn't such a good gap. This was okay, but into resistance. This was into resistance too. And then the stock doesn't care. If it's just crossing that 200, it will get bought. It gets lifted by that 200 period moving average. It's amazing. Same here, right into resistance, gapping from two green bars. Not a good gap, right? Doesn't matter. Got lifted by that 200. When a stock gaps way above the 200, and in this case not a flat 200, so it's not as powerful, you can look to play it long on a pullback to the 200. I'm not saying this was a good long here. We'd have to look at the smaller time frames, the intraday time frames, to determine that. But you see how it bounced right off the 200? It didn't even close the gap, or it didn't even reach minor resistance, which would have been down here somewhere. It bounced off of this. Now you might say, this is a small bounce. Yeah, well, that's almost $2. Okay? So if the stock is gapping well above the 200, then look to play it long when it reaches the 200, off of the 200. Take a look. In this case, it wasn't gapping well above it. It wasn't gapping just above it. It was actually gapping into it. Treat it as resistance. So how do you play it? You play it long if it pulls back off of it and gives you a buy setup. Does that make sense? So this is the daily chart gapped, as you can see, into the resistance, but also into the 200 MA. And then you don't want to play it long here. You would have gotten stopped out. But on the buy setup right here, long, stop right here. Entry should have been right here. And then target the prior high. Okay? So if it's gapping into the 200, it's resistance. So look to play it only on a pullback. The same to the downside. I've shown you only gap ups. Gap downs are exactly the same. See this? Right at the 200 MA. Guess what? That's support, right? That's support, right? Doesn't matter. Slice through it like a hot knife through butter. Bam! Big sell-off. And then continued lower. Right under, well, it wasn't exactly at the 200 MA, so it went up a little bit first, and then it dropped. But look how it respects that 200 MA. It's the granddaddy of all moving averages. It's the truth. I wouldn't be saying it if it wasn't true. It's the truth. Look at this, guys. Under support, but also under the 200 MA. Again, it wasn't exactly flat 200. Flat is always preferable, but it's still very, very relevant. If a stock gaps from being above it for a while to now below it, it's gonna get sold. It just is. In this case, it didn't really gap below it. It gapped right to it, initially got bought, but then notice how it immediately got snapped back and it got hit hard to close below it. Okay. In this case, below the 200, not quite at it, but still worked, right? So for I love it for gaps. I really, really love the 200 MA on the daily chart for as a gap strategy. Um, Now you can also use it as a breakout strategy. Look to buy stocks in an uptrend that base at or near their 200 period moving average as soon as the rising 20 catches up to price. Okay? Look to short stocks in a downtrend that base at or near the 200 as soon as the declining 20 catches up to price. Very effective for long-term trading, but also for day trading. So here's the picture perfect. This is a picture you'd be looking for. Flat 200, a rising 20 like this, and a stock that's basically trading off of the 20, the rising 20, and being halted by that flat 200. Eventually, where's it gonna go? You tell me. It's gonna result in a breakout. That's what's gonna happen. Now, if I can tell you, I mean, if I were to tell you how many plays I passed on that I didn't think looked good, like I didn't like the price action, but had that relationship between the 200 and the 20 that I passed on, if I were to recall how many of these I passed on that ended up working just because of the 200 and the 20, I'd be a billionaire if I took every one of them. But that's what we're talking about. Notice how it was bouncing off the 20, but the 200 is also keeping a ceiling. 200, right? 200, and eventually once it breaks out above it, the sky's the limit. Okay? This is recent. This happened recently. It's one of the pot stocks. What was it? NBEV or something like this? I think it's NBEV. NBEV, right? Take a look. If a stock is basing, it doesn't even have to be basing below the 200 or above the 200. The previous example was below. Just somewhere near the 200 on the daily chart, and you have a rising 20 that starts to curl. Oh my God, it is setting up as a long-term core play, as a long-term play. It's not even a short-term play. Look at this, guys. Love it. Look at this. Look at how tight this pattern was. Broke out, and then luckily in this case it didn't keep going. It actually continued to base. Notice that curling moving average just above the 200, and then look at the move. Beautiful. So the point is to say that if you have breakouts, if you have bases, if you have stocks that are basing on the daily chart, in this case, daily, weekly, monthly, but especially the daily, and they're basing right around the 200 period moving average. If they are, the moving average, the 20 period moving average is going to be flat initially, but once it starts to curl, you want to look to take that breakout because those they result in huge moves, in really, really big moves. Okay, as you can see. Okay, and more of the same, more of the same, more of the same. Where did this stock come from? Was basing at or near the 20, the 200. Moving average starts to point up, and look at the move. And this is perhaps my favorite. This is RYAM. I played it. Look at this, guys. Flat 200 and a rising 20. That's what I call the pinch play, plus a shakeout. So flat 200, rising 20, and the stock is oscillating between the two. Eventually, it gets squeezed by the 20, and it pops over the 200, and then bam. This was actually a play for as a swing trade for the strategic swing trader members. So does that make sense? Okay, any questions? Are there any questions about this? I see that you use the 8 period moving average. How do you use it? A good question. I use it for intraday trading. So I have the 8 period moving average on my 1, 2, 5, and 15-minute time frames. And I use it mainly in the morning for gaps because it takes a while for the 20 to catch up to price. So the first moving average that's going to catch up is the 8. So it's a very short-term moving average, the 8 period moving average. So I use it in the same way that I use the 20, but it's not as effective. It's not as powerful because it's not followed as much as the 20 is. But I use it in the same way that I use the 20, except it's a faster moving average, which means stocks in the morning that are gapping are going to react to it first. So that's why I have it. Okay, what else? Let's see. Yeah, are you going to be provided with a recording? Sure. I'll give you the link later on. Okay. Let's see. You managed to capture a picture of every slide. Good for you. Good. All right. What else? Any other questions? Okay. Any other questions? Again, for those that may be tuning in right now from YouTube or Facebook, we have an open house in the room, so come join us. Link is in the description. There's a link to join the open house in the description of the video. Thanks so much. If you have questions, you can always reach out to customer service. Okay. Thanks, guys. I'm going to stop the recording right now and then get back to trading.